Good evening, traders and investors. Will back here with another one, coming to you with a Wednesday market recap. Hopefully you guys had a very good day in the markets today. And in today's action, the SPY and the QQQ roughly muted during the normal hours, however, getting a massive pop in the after hours due to Meta and Microsoft earnings, which absolutely smashed it. Now, a bit of context, we were coming into this week saying it was a make or break week for the markets. The SPY and the QQQs had been running hot and had been very extended. And as a result, from these earnings releases that we're going to have today and tomorrow with Apple and Amazon, we were saying that one of two scenarios was highly likely. In the event that the earnings were all good and well received, and the macro was well received as well, because we got some data on GDP and some insights from Powell too. Well, if everything was good, we were going to get possibly the continuation into some form of a blow off top, which would cap off the month of July, which is a seasonally good month, in a bit of a boom. That was the bull case. The bear case was if macro data was bad, Jerome Powell wasn't nice to us, and if big tech earnings were somewhat sluggish, well, we would probably embark on a leg of weekly consolidation. Well, happy to say, guys, that it was actually option number one. We are moving directionally higher, and everything seems to be fairly good in terms of sentiment around the big tech earnings that we got tonight. Still have Apple and Amazon to be reporting tomorrow, of course. I'll remind you, it's not our job to predict the markets as traders. It's our job to react to price levels, find good risk to reward, establish some trades with some stop loss and take profit levels, and then just ride it out. If you're a long-term investor, the thesis is still so simple. DCA with every single one of your paychecks, or when you get some fantastic discounts in the market, that is when you should be picking up these names, not chasing them after their all-time high rallies, especially for long-term portfolios. You should be building your core positions when the market is giving you time and time again opportunities to do so, either in a range or, in the case of Meta, let's say, at some extended dips during tariffs. So congratulations to all Microsoft and Meta shareholders out there. You guys must be pretty happy, especially for your long-term portfolios. Now, in today's video, we have a ton of things to recap together. Number one, we're going to be going over, of course, what was said today in the Federal Reserve meeting. What did Jerome Powell have to say to us? And we'll do a quick recap of the macro data points that came out today, such as GDP and stuff like that. That's going to be number one. Number two, I have 4 earnings releases to go through with you guys today. Number one and number two, of course, are going to be the big boys, Meta and Microsoft. But thereafter, we're going to have a look at Robinhood and cap it all off with ARM at the bottom of the list here, which you can't see because my big head is in the way. There it is, all the way at the bottom. So we'll be doing Meta, Microsoft, Robinhood, and ARM. Special shout out to all the other companies reporting today. Maybe we'll do some catch up and do a couple of them on the Friday session, but those are going to be the ones for today. After we're done with those earnings releases, we will take a look at our major market indexes. How are we moving? How is the rotation looking coming into tomorrow's session? And thereafter, we will do the same thing on our big tech list. Take a look at some of our big tech names after today's gains and losses, establish some possible entries for some directional trades, or which of these companies still represent some very good opportunities for long-term portfolios as well. So that's going to be everything for today's video. And at the end of the video, if I have some time, we'll go over the biggest gainers and losers of the day and maybe do a little bit of earnings prep for tomorrow, because you guys know we're going to be looking at some pretty nice companies tomorrow. Apple, Amazon, Reddit, you have MasterCard down here as well, Coinbase, Cloudflare. So we'll be doing a little bit of pre-market prep in terms of what we can possibly have for tomorrow's earnings. That being said, that'll be everything for today's video, but may as well jump into it right now because it will be a long one as we explain all of these concepts together. So in terms of the SPY, guys, up, or rather down on the day, 0.13, but up 0.61 in the after hours because of Meta and Microsoft. The QQQ's actually maintaining green today, 0.13, and up 1% in the after hours as well. During your normal session, you actually had a very mixed market. As a matter of fact, it got a little bit weak when Jerome Powell was talking, and we're going to get into that in just a few short moments when we discuss what was said during that meeting to result in some of the sectors here coming down. But overall, very mixed market. Some of the semiconductor names still doing good. Microsoft and Google were performing well today, but we did have some losers here. Apple and Amazon. Amazon's up 3% in the after hours today. So, you know, you got to kind of take these numbers with a grain of salt. And Apple has earnings tomorrow. Financials, not too good of a day. Healthcare down as well. And the bottom half of the market not responding too well because yields had a bit of an increase after what Jerome Powell said. On the one-day relative performance, this will all shift by tomorrow. We had utilities, technology, consumer communication services higher. Probably tech and communication services with Meta are going to be flying tomorrow. To the downside, pretty much everything else. So it leaves us on a one-week relative, guys, at the midpoint throughout the week. Obviously, this is going to change drastically by tomorrow in terms of sentiment that the big tech earnings will bring into the markets. But as it stands right now, we have been slightly weak on the S&P throughout the week. A little bit of consolidation, right? Monday and Tuesday, red days in the market, and QQQ kind of flat as well. But since we have such significant changes today because of earnings, of course, that will all shift. Now, before we get into more technicals and before we get into the earnings, let us cover exactly what was said by Jerome Powell today in the meeting, all right? So number one, Fed recap. Powell says no decision on September. Must wait to see the tariff impact on inflation. So leading into today's meeting, we were thinking that we might get a little bit of signaling in terms of the September rate cuts. Sadly, that did not happen. Jerome Powell staying very firm, not wanting to comment too much on the direction of or rather on the path of interest rate cuts into the month of September, and basically kind of just skirting around every single question that he could. Let's go over a few of the highlights, though. He did say that everything didn't look too bad as of right now. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. So once again, acknowledging the threat of tariffs, but also acknowledging the fact that they haven't really made their way into the data just yet. Powell said that a reasonable base case could be that the effects to inflation will be short-lived. For the time being, we're well positioned to learn more about the likely course of the economy and the evolving balance of risks before adjusting our policy stance. The balance of risks always for the Federal Reserve is between inflation and the labor market. Let's move a bit further down here. So we'll have a look on a few more things that were said by Powell. Modestly restrictive policy still seems appropriate here. So saying that rates might just be perfect where they are. Today, we decided to leave our policy rate where it's been, which I would characterize as modestly restrictive. It seems to me, and to almost the whole committee, that the economy is not performing as though restrictive policy is holding it back inappropriately, and modestly restrictive policy seems appropriate. Basically saying, listen, even though rates are very high right now, the economy doesn't seem to be punished by those high rates. So as a result, they still deem them to be the rates to be moderately restrictive, not too restrictive that the economy is really slowing down, but just restrictive enough, which is why they don't necessarily feel any rush to drop interest rates just yet. All that said, there's also downside risk to the labor market, meaning if you keep rates too high for too long, maybe the labor market destabilizes, and that's also not what they want. Once again, referencing the balance of risks between inflation, which could come from tariffs, and of course, the labor market. Economic growth has moderated, but Fed positioned to respond, said Powell. Growth in the first half of 2025 slowed to 1.2% compared to 2.5% last year, said Powell. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments, saying that, yeah, essentially if the labor market erodes and inflation from tariffs is not that bad, we'll probably be in a position to cut rates to accommodate the labor market and to accommodate the economy overall. I mean, we can go through more questions here, guys, but it's really more of the same, right? Acknowledging that the data is not bad yet. Like I said, he kind of tried to get around the questions for a September rate cut. Didn't give too much, but pretty much said as of right now, the policy rate is fine and he's in no rush to drop it just yet. And of course, the market did not really like that when he was speaking. You can see a very clear impact as to when he was answering those questions. This was the Federal Reserve meeting. The market didn't like it for the simple fact that, well, it decreased the odds of a September rate cut. You can see here that the meeting probabilities for a rate cut for the month of September, well, just one day ago, they were at 63%. 63% odds of a rate cut in September. So a bit better than a coin toss. Now, sadly, guys, the odds of a rate cut have dropped to 45%. So the market had to kind of price that in relatively quickly while he was talking. And of course, these candles right here are the after hours with your earnings. So we didn't really get much, guys. I would say that the Federal Reserve meeting was a bit of a nothing burger. But once again, putting the September rate cut in question. Will it happen? Will it not happen? As of right now, the market still deems it to be relatively a coin toss. So that's everything from your Federal Reserve meeting. We got more economic data today, though, that showed that maybe Jerome Powell is not wrong. I'll remind you guys, right? In terms of longer term yields, if the Fed cuts, but the economy is doing really well, long-term yields are not going to drop because they'll think that the Fed is possibly making a mistake. The last thing you want to do is cut interest rates into an economy that's going super hot. That's never good. That will possibly lead to inflation, right? But in the event that you see economic contraction, and then you cut rates, well, then the longer term yields will come down. So the Fed's in a tight spot. I know President Trump and his administration wants Powell to cut rates, but the longer term yields are telling you, well, the bond market is telling you essentially that even if you do cut rates, longer term yields, especially those associated with mortgages and stuff like that, may just not come down because the risk premium is still there. Now, moving into the data that we got this morning, GDP actually came in very hot, guys, 3% versus the 2.4% expected. Definitely not showing economic contraction there at all. In terms of your price index for GDP, 2%. So inflation is kind of dead right now, guys. You're not seeing it in GDP, you're not seeing it in the CPI, and you're also not seeing it in the Trueflation numbers, which measures over 30 million different products. You guys can go to this website right here. It's called Trueflation, right? We just go to this website right here. It's an independent research if you guys don't believe in the, in the numbers that are reported by the CPI. And you'll see throughout the month of July, we started off at like 1.67, and now we're kind of sitting at about 2%. This is year over year inflation. Inflation is just not here at all. We're not saying that it's not coming in the future, but as of right now, the data is not reflecting that at all. Now, we also got core PCE, a preliminary number. I'll remind you, the true one is coming out tomorrow morning, but we got a bit of a glimpse into that, and that was at 2.5% versus the 2.4 expected. Slight little uptick, guys, but much better than we've been seeing in, 6 months ago, 12 months ago. So the trend of inflation is very clear in my mind right now. So we are midway through the week. The only new development that we will be waiting for tomorrow are going to be the PCE numbers, the official ones. Then on Friday, we're going to get data from the labor market. We get the good old non-farm payrolls and the unemployment rate. So that should be fun. Those are your only remaining macro catalysts for the rest of the week. So as a result, the markets kind of tried to price in the fact that we may not be getting a rate cut, and then the earnings kind of took over in terms of the price action. So all things considered right now, guys, there is still no red flags whatsoever for this market, for the economy. We're not saying that there's not going to be some, but as of right now, we're kind of like the Fed. We will take this one day and 1 week at a time. No sense to predict in terms of direction. We will just react to the price action when it happens, as we always do on the channel, right? So moving forward, guys, we're going to start tackling some of our earnings, and we got some big ones. We're going to start it off with the two biggest ones, and we're going to start this one off with Microsoft. So Microsoft coming out with earnings after the bell today. They are up almost 8 to 9%. Fantastic release from Microsoft after rallying the entirety of last quarter. They actually had more in the tank. We were coming into this earnings saying if they did not beat by a perfect margin and did not raise guidance, the stock price may suffer a little bit just because of how hot it had actually ran. However, this was a case of absolute perfection, guys. Microsoft reporting some fantastic numbers. Let's jump into them right now. So take a look at this beat right here on EPS. 8% beat on EPS. That's not easy for a now $4 trillion company to do. And a 3.5% beat on revenue as well. Fantastic earnings from Microsoft. Let's jump into some of the numbers here. You will see that the revenue number was up 18% year over year. That's not easy for a company of Microsoft's size to do, but they did it again. The Azure growth rate was up 10%, essentially 1,000 basis points. Look at the growth rate from Microsoft Azure, looking extremely strong. It was kind of stuck down here at the low 30s for the past couple of quarters. 39% year over year. Look at these operating margins. Microsoft is the king of maintaining margins, and they did it again. Very strong operating margins, 23% gain in operating income, and a 24% year over year beat on EPS. Absolute perfection from this company. Let's move into some of the headlines here. Microsoft stock pops 7% on earnings beat as Azure annual revenue tops $75 billion. Very, very strong. That's actually Azure and all of their cloud business too. So let's take a look at here. Net income increased to $27.23 billion from $22 billion just a year ago. For net margins, that is fantastic net margins for Microsoft, 35.6, which is in line with the company's standards, but they're able to raise the bar time and time again for those net margins. The company's intelligent cloud unit was up 26% for the year. You'll notice, guys, these numbers are all insane. For a company the size of Microsoft to be growing every single line of business almost by double digits is absolutely nuts. Revenue from Azure and other cloud services was the $75 billion number. That was up 34% from the prior year. It includes other cloud services. If you were to only look at Microsoft Azure alone, 39%. I know some people say Azure, some people say Azure or Azure. right? The French word is azur. That's how I pronounce it, right? So it's just because of my background. So I'll pronounce it the way that possibly it should be pronounced. You guys can pronounce it however you want. Now, keep in mind, guys, analysts had expected growth between 34.4 and 35.3. So massively beating the benchmarks right there. Take a look at all their other lines of businesses, guys. Dynamic products and cloud services, 18%. This is an increase. All of them almost increases from last quarter. And last quarter was pretty good. Microsoft 365 commercial cloud, 18%. Microsoft 365 consumer products and cloud services, 21%. AI is working. We're going to get into it. Search and news advertising, 21%, equalizing the last 2 quarters. Windows OEM Plus devices, 3%, but that's been soft over the past few years. But we are starting to see a rounding of the bend for the company. At least that's what the CEO was saying during the earnings call. And Xbox and content services, their gaming division, 13%, very strong for them. Their productivity and business. So they divide all of these lines of businesses, guys, in 3 main units. We're going to go through those 3 main units now. I'll show you a little graph just to begin with here. Productivity and business processes, guys, that's the blue line right there. Fantastic growth over the last 3 years. Intelligent cloud revenue, which does include Microsoft Azure, very strong growth, which is the orange graph right there. And more personal computing, the purple, also growing. All 3 major segments of the business growing. Here's by how much. Productivity and business process segment was strong, $33.11 billion versus the analyst consensus of 32. $1 billion beat there. Number 2, the company said the adoption of Microsoft 365 Copilot, their AI features, led to higher revenue per user for Microsoft 365 commercial cloud products, such as Office, the Office productivity software bundles. The more personal computing unit, which is this line of business right here in purple, that one did very well today. They totaled $13.45 billion in sales. That was up 9% and also almost $1 billion higher than the street estimate. They're just crushing every single estimate right here. PC shipments actually were up 4.4% in the quarter, and that is actually much better than it has been doing in the past 2 years. Microsoft had $24.2 billion in CapEx and assets acquired through finance leases for the quarter, up 27% from a year earlier. This is the data center ramp, guys. So CapEx is going up and are spending a lot of that money on data centers and ramping their AI offerings, the same as Google told us to, and the same as Meta told us, which we're going to get into in just a few short days, or just a few short minutes, excuse me. I'm reading a headline at the same time. Earlier, they laid off more than 6,000 people, not because the company's struggling, but because they're becoming more and more efficient. The CEO obviously saying that a lot of lines of code for the business now are being written by AI, so they're saving a lot of fees here on paying out software developers. Overall, though, guys, a fantastic quarter. It is a bulletproof earnings report from Microsoft, one of the best that we have seen arguably in the last year of trading. You might remember Microsoft was stuck here in a range, and I was buying the dips at the bottom of this range for my long-term portfolio, culminating in some heavy buys prior to, the tariff pause essentially during Liberation Day. That was the last time. I mean, I've been adding these. I've had Microsoft for a long time, but I was adding here, adding there, and now we just kind of reap the benefits of all of those additions. So hopefully you guys were also able to follow along. You guys must be up some tremendous amounts of money right now, and I'm very happy for you. Here's what Satya Nadella had to say. Cloud and AI is the driving force of business transformation across every industry and every sector, and Microsoft is investing a lot of money so that they stay at the forefront of AI. So there's really nothing else to say, guys. Nothing else to dissect, right? Sure, operating expenses were up slightly, but the revenue growth rate outpaced the expense profile. So essentially the company has positive operating leverage too. This is one of the strongest companies in the entire market, not just because of this quarterly earnings. No, they have been one of the strongest companies in the market. Their net margins, 35+%, are fantastic. Microsoft has one of the best balance sheets in the entire game. They always have, and they probably always will. Tremendous amounts of free cash flow. They always have a decent amount of cash on the balance sheet too, although they've been spending some of that for their capital expenditures, and not that much debt overall in relation to the revenue and free cash flow. Balance sheet has always been an A+ and probably will remain an A+. Extremely well-run company, very consistent EPS and very consistent revenue as well. During the last 2 bear markets, COVID and 2022, Microsoft was continuously expanding. So now it's getting a piece of the AI pie, but behind the AI as well is a very solid and very well-run company, which has so many different aspects to its business. I mean, look at all this. It's such a well-diversified company overall. So very happy for all you guys. Congratulations. Is Microsoft a buy now? Should we be having FOMO at 557? You guys know what I've been saying, right? I haven't added Microsoft for a while. If you're feeling FOMO right now, that's kind of on you. We had more than enough opportunities, but who knows? Maybe you're a new investor to the market. However, Microsoft right now at 550 is pushing the top end of historical valuations, trading at a 41 forward price to earnings, almost a 3 peg, and a very low free cash flow yield of 1.78. I'll remind you guys, down here, Microsoft was trading high 20s price to earnings. That's where you want to buy it. As of right now, I cannot say this one is a buy. I'm very happy to be a Microsoft shareholder, but this one remains a hold from me. It's been a hold the entire time. And you can say, yeah, well, if I would have bought here, it would have probably given me some profit. And this might be true, guys, but it's all about good habit building in the future. You guys should have a well-diversified portfolio. Sometimes stocks will run, and that's okay. They'll run to highs, and then after they will pull back, and we can then buy them on pullbacks when the valuations make sense. But sometimes they go on these 3 to 6 months worth of rally. So if you were a shareholder back here and you were accumulating, or maybe you hesitated, now you might understand. Don't hesitate. If you're in it for the long term, you're in it for a long term. Any single share you buy in a company for a long-term portfolio, you should be willing to hold that one for 5 years. So if it accumulates for a year, that's okay, because then you get the massive rallies. Microsoft, unfortunately for me, I cannot say it's a buy up here. I'm very happy as a shareholder. I'm very happy for you guys as well. But unfortunately, right now at the top end of valuation, it just does not give the compound annual growth rates that I'm looking for the next 3-4 years if our average cost is there. How would I approach this if I have no position? Well, the same thing I've been saying since back here. Maybe you can nibble, and when it goes on an extended dip, well, then maybe you can build further into the position, but continuously chasing something at the top end of its valuation, guys, in my opinion, it never results in the best compound annual growth rates, but you guys are free to do what you want. That is my analysis on Microsoft, and that is the end of their earnings. Company number 2 is going to be Meta. Meta coming out with earnings after the bell. This company is up 11.24% in the after hours. Meta absolutely destroyed these earnings as well. And I was looking forward to this one, guys. We were commenting on the fact that, yeah, Meta was indeed a nibble down here. Although I was pointing out that, several times over the last couple of years, Meta was indeed some buys, especially during the tariff sell-off. It was a heck of a buy. It was still a nibble here. And even when I go through the price targets here and the current valuation, even at the all-time highs, Meta is actually a better buy in terms of valuation than Microsoft is right now. And we're going to get into that, but they absolutely smashed it, guys. Absolutely destroyed these earnings. This is picture perfect perfection again, which is what we are. I know I just did a double, right? Picture perfect perfection, but still, who cares, right? I'd like to see you guys do these videos, 1 hour, no edits, right? I just run straight through. So sometimes forgive me for misspeaking. Now, okay. So in terms of Meta right here, 11.29% to the upside. Fantastic earnings. Look at this EPS beat. They absolutely destroyed it, guys. 21% beat on EPS. Nuts. And revenue, 6% beat on the numbers too. Meta, fantastic numbers. Let's get into some of these metrics, shall we? Revenue up 22% year over year. Family daily active users, that was up 6% year over year. 3.48 billion daily active users, which is absolutely nuts for Meta across its different suite of products, whether that's Facebook, Instagram, WhatsApp, and their different suite of products there. Operating income, 38% year over year. Yes, expense profile was rising for Meta as a result of their spending on CapEx and a bit more operating expenses overall, but the revenue outpaced it, guys, which is why you're seeing a fantastic gain in operating income and EPS 38% year over year. Fantastic numbers. Look at these operating margins too. They're still, even when they're spending so much money on CapEx, they're still able to keep operating margins so high. They make so much money on ads, and I'll show you how much pricing power they actually have for their advertising business. Let's move into it. Meta shares climbed 10% on revenue beat and a raised forecast. Double beat and a raise from good old Mark Zuckerberg. The advertising revenue for the second quarter came in at $46.56 billion, ahead of the estimates of about $44 billion, guys. That's $2.5 billion of beats on advertising revenue. That is very, very, very strong. They're usually not beating by that much versus the consensus. Extremely strong. Because of AI, they unlocked greater, this is what Zuckerberg highlighted on the earnings call. The reason for this is the gains that they've been having from AI, the efficiency gains, to give greater efficiency and gains across our ad system, making the ad system more efficient and more targeted ads, depending on the type of business that you choose to advertise on different platforms across Meta's landscape, whether that's Facebook or Instagram. Let's say you have a I don't know what type of business you might have. Maybe you have a clothing brand, maybe you have a restaurant or stuff like that. Because of AI, it's allowing Facebook to target consumers of that possible business a lot better. So businesses are winning, but Facebook is winning as well. Moving on to this, these factors will result in a 2026 in terms of the compensation relating to hiring. I don't know why my highlights disappeared here. So Meta said compensation related to hiring will be the second largest driver of growth. And these factors will result in a 2026 year-over-year expense growth rate that is above the 2025 expense growth. You know that they've been doing two things. Number one here, they've been investing more in data centers just in straight CapEx. They actually raised the target of CapEx. It was 64 to 72 billion. Now they raised the bottom end from 64 to 66. Top end is still 72. So Mark Zuckerberg investing more and more in infrastructure, but also you guys have been seeing he's been poaching a lot of employees from different businesses, trying to build his super team for AI, as he calls it, right? The super intelligence team, to be quite precise. Meta's total costs and expenses for the quarter were up 12% year over year. That's fine. So long as you are growing revenue faster than you're growing your expense profile, that is positive operating leverage, and the business will be at a net gain as a result. The company kicked off its AI hiring bonanza in June when it invested $14.3 billion into Scale AI, landing the data annotating startup CEO Alexander Wang to co-lead the new Meta Superintelligence Labs as a chief AI officer. You guys know he's also been trying to poach employees from OpenAI as well. Over the last few months, here's what he had to say, Mark Zuckerberg. Over the last few months, we've begun to see glimpses of our AI systems improving themselves. And the improvement is slow for now, but undeniable. Developing superintelligence, which we define as AI that surpasses human intelligence in every way we think, is now in sight and is currently doing a lot of good for their advertising business. Meta's net income in the second quarter rose 36% to $18.34 billion. The net margins for Meta right now currently stand at 38.6. That is down from over 39 last quarter. And 2 quarters ago in Q4 of last year, it was about 40%. So yes, they're spending a bit more money, but their efficiency is still very, very, very strong. Nothing bad to say about Meta's earnings as a whole. Let me just show you some of the numbers from Meta just to show you how strong this business actually is. Every single segment, whether it's Asia Pacific, Europe, the US, and Canada, every single segment, guys, is growing advertising revenue. Every single segment, none of them being left behind overall. In terms of these segment results, well, there's really only advertising, so we're not going to go over that. Advertising and family of apps is usually the same thing. The only other thing is they're still hemorrhaging $4 billion a quarter. Could you imagine what Meta would be without this investment in Reality Labs, which so far doesn't really have any revenue to show for it? Here's your revenue. $370 million of revenue, and it costs them $4.5 billion. The company would be even more profitable, but at least they're spending their money on something, their next possible growth driver. Whether it works, whether it doesn't work, I don't know, and probably neither do any of us, but still, they're making some investments. If it fails, they can at least say they tried. It's not as if they don't have the money to do it, right? So you can see a bit of an operating margin compression right here. As in the last few quarters, they've really been spending a lot of money on on the CapEx spend, and now in terms of new employee hiring. But look, expenses as a percentage of revenue. So you can clearly see their revenue is ramping faster than their expense profile. Here are the last 9 quarters, and now it's representing a smaller portion of total revenue, which is also very good. Net income up and to the right. I'll show you a graph for the net income. Hey, take a look at right here. I know there's a lot of lines, so please don't have a seizure on me, but here's your free cash flow in blue. Look at the free cash flow columns. This is from 2015. Their free cash flow, that's the amount of money that they spend on data centers and stuff like that. You can see it peaked 2 quarters ago. Then they began investing heavily. But still, free cash flow, it can fluctuate, but it is a lot higher than we have seen in prior years. Their net income, which is the orange bars right there, you can see net income is moving higher, and every time it moves higher, they spend a little bit more money either on hiring employees or other things of that nature. But overall, we can see the trend is clearly up, and total revenues, we don't even need to talk about it, guys. The company is just an absolute money printer. Let's move on to further slides here. In terms of the CapEx, you guys can see the CapEx for the quarter. We talked about that too. Family, daily active people. You guys can clearly see the progression here. The average revenue per person, very strong, guys. This is what Spotify was struggling with yesterday. You remember we saw average revenue per person for Spotify yesterday was struggling a little bit here. Look at Meta's. Higher and higher and higher. Some quarters are higher than others, but still you can clearly see a defined trend here. They're able to monetize their customer base, but because they have a lot of pricing power, guys. They're a very powerful advertising company. When they raise prices, people usually will pay, especially if people are getting the right impressions on their ads. Take a look at those impressions. Worldwide, 11% bump on ad impressions, which is absolutely nuts, guys. You love to see that. Average price per ad, this is their pricing power. They're able to increase prices 9%, and people will pay, especially if they're getting very good results. Overall, guys, a picture-perfect quarter for Meta as well. That is exactly what Wall Street was looking at. We know that Wall Street has been struggling with earnings recently. If they're not perfect and they don't completely surprise everybody, the stock has either traded at flat ROI in the after hours. In the event that the revenues or other expectations are coming in line for other companies, we went over a lot of them yesterday, right? IBM, Texas Instruments, so many other companies, Netflix as well. If they just came in line and they weren't too fancy, they were doing nothing. They were either flat or down the day after. But when you give the street such a massive surprise, well, that is when you get the massive outperformance. Meta moving 2 standard deviations. Microsoft as well, almost. The expected moves on these companies were right around 4 to 5%. As you can clearly see, they're moving 2 times that. So obviously this is beyond the expectations for the street, which is exactly what you want to see. At 700, well, when I was doing this, it was at 760. At 770, roughly, is Meta still a decent buy? You know, whether you already have shares, is it a decent DCA? If you're brand new to the markets, is it a good buy for long-term gains? Well, actually, as a matter of fact, it's not too bad. So in terms of their forward price to earnings, guys, we're currently sitting at 29.48, still under a 30 forward price to earnings. That's not too bad. Meta is often traded as rich as 35 to 40, such as what Microsoft is doing right now. The forward PEG ratio, just because they're not increasing EPS that fast per year, this might get a bigger bump once they're done their CapEx cycle. But right now it stands at 2.27, which is a little high, but still manageable for a company such as the quality that Meta has. In terms of free cash flow yield, it's a bit low at 2.7, but the forward price to sales, in terms of this should be 2028, my bad. 2028 price to sales, guys. And the reason I bring this up is because if you are a long-term investor of Meta, right? Traditionally, Meta has traded at a 10 price to sales for the upcoming year. If you look at 2028 forward price to sales, right, you still do have some expansion on this stock. If we were to just take a 10 normalized price to sales, their sales figure for 2028, guys, at this point in time is about $280 billion. So let's just call it that, yeah? $280 billion if you give them a 10 forward price to sales, which is what they should have by 2027 type of thing for 2028. Well, that would give you a market cap of about 2.8 trillion. The market cap right now is sitting at 1.75. That could give you 60% more upside from here, which would put Meta well over $1,000. Matter of fact, way higher than that. It would put Meta by 2028, right? We're driving long-term price targets, yeah? Maybe $1,200, $1,300 if they can't achieve everything they set out to do. If they get more profitable after their CapEx, if they get more efficient, it may be more than that. But if your timeline is 2027, 2028, you still have a very good compound annual growth rate in the stock, which is why I say Meta right here is still a buy. If you already have a full position that you've established years and years before, well, maybe you don't want to double up your position, but it is still a nibble for me. Any pullbacks will also be synonymous of a nibble. If you're brand new to the market, then I don't believe it's the worst idea to start a position on Meta. Not financial advice, of course. You do your own due diligence, but the valuation, it's not that bad. So if I were brand new to the market and I didn't have a portfolio and I was looking to start, I would consider adding Meta up here, maybe not with the full amount that I'm willing to give to it, right? But if we have some consolidation through maybe the fall months when the market seasonality kind of gets a little bit more choppy, I wouldn't mind building a position on Meta, knowing that the growth prospects for the company in the next few years still are very strong. That's everything I had for you guys for Meta, but in terms of a swing trade, guys, swing trades from here are kind of out of the question for right now, but I'm happy that I was able to add some last shares in my own portfolio before we kind of started this massive rally right there. That's everything we had for Microsoft and Meta. Now let's get into a bit of a fun one. Well, those were fun, right? We're going to get into one that's of high, of a high interest in terms of retail, right? So we're going to get into this one. I'm sure a lot of you guys are curious as to why Robinhood, even though they had fantastic earnings, are down, sadly, about 0.44%, and we're going to get into it. But this company as well reporting earnings after the bell. There's a lot of hype around this one, a lot of bullish retail sentiment. Has it performed as best as it could already, or can we maybe see even further gains in the near-term future? Let's take a look here, shall we? EPS beat, fantastic beat right there. 37% beat on EPS. and an 8% beat on revenue. All numbers were excellent for Robinhood. Absolutely stellar. The one little problem, guys, right now as it stands, is possibly the valuation. It's kind of like Palantir in that respect, not as rich as Palantir, but the valuation is somewhat questionable. And that is even with such ridiculous numbers for growth, which we're going to get into right now. So in terms of the numbers for Robinhood, guys, it's very tough to find anything wrong with what they just delivered. Revenue was up 45% year over year. That is ridiculous. Gold subscribers up 76% year over year to a total of 3.5 million paying members. The EBITDA margin was also nicely up and to the right. Platform assets up 99%, almost a double. $280 billion of platform assets. Now, of course, that's because a lot of the asset values have been coming up. And we have adjusted EBITDA here up 82% year over year. Fantastic. So not only stronger revenue, but also bringing a lot more money here to earnings and then thereafter to the bottom line in terms of net income. Let's take a look at the article and see, why is Robinhood roughly flat despite these massive numbers? Let's have a look, shall we? So they report second quarter earnings beat with revenue climbing 45% over last year, which is what we just saw. Net income more than doubled to $386 million, which was fantastic. The number of funded customers climbed by 2.3 million to 26.5 million funded customers. That was almost 10%. Very strong there. That topped the estimate of 26.1 from the street. Investment accounts also grew 10% year over year. Don't worry, I'll show you all the earnings slides. You don't have to remember these. I will show you all of the increases in these numbers, but just going to get through the article first. Total platform assets nearly doubled, which is what we just saw, 99%, driven by strong net deposits, acquired assets, and higher equity and cryptocurrency valuation. So yes, more deposits, but also higher valuations, right? Total operating expenses increased 12%. That is fine. The revenue far outpaced that, so the company still was with positive operating leverage. And in terms of the transaction-based revenue right here, which is a proxy for trading activity, they had $539 million, which was a beat by about 20 million here versus the street estimate. So very good. Options trading contributed 265 million. That also beat the consensus of 250. However, there were a few aspects where they did miss. Cryptocurrency trading was a bit light. They came in at 160 million versus the 168 million expected. And equities trading volumes, or rather revenue for them, actually came in a bit light too at 66 million versus the 69 million expected. So options, very strong, but crypto and equities, a little bit underwhelming, right? And this report had to be absolutely perfect. This quarterly earnings season is all about perfection. And although several metrics from Robinhood were fantastic, you can start to see, right? As soon as there's some little imperfections, it's enough. This shouldn't be surprising. We've seen it so many times throughout this quarter so far. Net interest revenue was 357 million, beating the expectations of 306. So that was very good. They earned interest from margin accounts, of course. And average revenue per user rose 34% year over year to $151. So they're able to monetize their users very well. Investors have been watching closely for updates on Robinhood's expansion into crypto infrastructure and tokenized finance, particularly after its launch of synthetic stock tokens for OpenAI and SpaceX. So talking about their European expansion overall. Speaking about those expenses for their expansion, this is another thing that, it wasn't necessarily good for these earnings, right? They're spending a bit more money, but not that much more than they've previously described so far. The company emphasized ongoing product velocity, including the launch of tokenization, which we just talked about, the acquisition of Bitstamp, which is expected to close in 2025, and new products like Robinhood Strategies, Banking, and Cortex. This is the earnings call transcript, by the way. Now, in terms of their expenses, they updated the full year 2025 expense outlook to include $85 million in costs related to the Trade PMR acquisition, setting combined adjusted operating expenses and stock-based compensation at 2.085 to 2.185 billion, which is larger than what Wall Street was anticipating. So several tiny little misses here on crypto and equities trading, and also slightly higher expenses than previously anticipated. Those two things were slight little pain points in the earnings, but I mean, you can't really call them pain points, right? They were just the tiny little misses. And every one of these tiny little things does, make an impact on the broader picture here, as opposed to Meta and Microsoft, where it just smashed every single metric, right? Now, in terms of the further expansion plans, the company's global ambitions are clear. A new office in Toronto, expansion into Asia with Singapore as a regional hub, and plans to bring tokenized equities to the UK and the US after trying them in Europe. So let's talk about some of the numbers, guys, because they were absolutely fantastic. I'll show you some of these charts, and they were really, really good. Here's our funded customers progression. Fantastic. The gold subscribers progression, fantastic. 13.1% year over year. Very strong right there. Total platform assets up and to the right. Substantial gain on TPA right there. And net deposits. Here was something that kind of slowed down over the course of the quarter, right? So especially in relation to last quarter and Q4, this also, net deposits, not so much. So maybe clients have already deposited all that they wanted to do. But as a result, guys, you can clearly see, right? This was not as strong as the last 2 quarters. So maybe acceleration is not going to be vertical just yet. Maybe we will have some lumpiness in terms of net deposits. And Wall Street does pay attention to that, especially when a stock is trading at very rich multiples, right? When they can't show consistency across those net deposit metrics, it does have an impact. We're just trying to find justifications as to why the stock isn't up 2,000% right now in the after hours. Now, total net revenues was up fairly nice, but still under what we had in Q4. So keep that in mind too. Adjusted operating expenses, we already talked about that. That was up 9% year over year. But I mean, total, several segments of revenue were up higher. But here you go, guys, right? Here you go. Operating expenses were not the cost of revenue, but operating expenses did outpace revenue. So that's a little bit of something that you got to look out for right there. In terms of net income, that is up and to the right, very strong, and adjusted net income right there. Funded customers, we already been over. This is something I wanted to talk to you guys about. Total platform assets. Where are those gains coming from? Which segment? You can clearly see equities down here is in green. Nice little uptick right there. Options and futures, the lime green area, that was a sector that performed quite well for them in terms of just the values that they're getting from this, right? Cryptocurrencies, which is going to be your second tiny little lime green segment right there. You can see at number 2, it's barely visible, but that was there. And then net cash held by users at about $33 billion altogether was not too bad either. And then you have the retirement assets, which are right there. Robinhood's been doing a very good job of increasing its retirements, assets under custody. They can't say under management because they don't management, but more and more people, guys, have been moving their retirement accounts to Robinhood, which is very good, right? The company can show just more, just cash in their platform overall, and that's very, very, very solid overall in terms of the picture of Robinhood, right? Not being so much viewed anymore as a one-stop shop for speculative trading as it once was viewed, but now actually a financial hub for people looking for, to put the retirement plans there and keep the funds on the platform. So building a bit more trustworthiness in terms of the overall platform, which is exactly kind of what you want to see. We talked about net deposits. That was kind of down in relation to the last 2 quarters. Not something that you would have wanted to see, but we kind of tried to explain maybe a bit of seasonality, a bit of cyclicality here overall. So you can see the equity notional volumes in terms of trading. Equity, very strong, but options, although was good, it fell short of the estimates. I'll remind you, right? And then also the crypto notional volumes, that was also okay, but fell short of the estimates. Or sorry, option was good. Equity was under. Sorry, it's tough to remember from this article right there, but still, you can get kind of the impression as to what I was saying, right? Crypto was light. All of them kind of were good, but some were lighter than the expectations. But you can see here from the slides, I mean, options, very strong. Equity, still very strong as well, but came in slightly under the estimate, and crypto did as well. Options was the one that beat, my mistake. But you can clearly see Robinhood for crypto here. The crypto money really flows into here when you're in massive everything expansion, not only Bitcoin expansion, but also all altcoin expansions. And so far, we've kind of only seen the major altcoins such as Bitcoin, Ethereum, and Solana, right? Not too much of stuff elsewhere. So all in all, guys, fantastic report. I mean, we can go through every single slide and it's all very good, but there were a few pain points that we did raise. They missed a few estimates. They also missed on a bit of their, expense profile estimates. So raising expenses by a little bit there to expand the business. I mean, any expenses that the company incurs to expand are good, right? What you want to kind of avoid is useless stock-based compensation and other things of that nature. But so far, the company's spending a lot of money to expand, which is a good thing for the business overall. Now, the one main thing about this company, guys, is and has been for several weeks in a row now, the valuation. So let's talk about it. At 107, where the company roughly stands in the after hours, you're standing at a forward price earnings of 81, which is not too bad if they have a very strong EPS growth rate, but they don't. When you see a very high priced earnings, the first thing you should look at is how fast are they growing their EPS? Because you can have a very high price to earnings, but if they're growing EPS at 40%, they'd only have like a 2 peg, which is not terrible. not terrible. However, they're only growing EPS by about 15% per year, which gives them a peg of 5.59. That is very expensive, guys. You're paying a lot for this growth, and we've done the numbers through 2028. It's not as if I'm only taking in consideration next year's growth. No. I'm taking in consideration the average of the next 3 years worth of growth on EPS. And also sales too. You can see the sales are ramping very nicely, but kind of tapering off come 2028. So it's not as if the sales are going vertical right now. They have a very nice expansion rate, but not much more than that. You know what I mean? So even if you don't want to take earnings and you're saying, well, earnings are coming off zero, it's not the best metric. Okay, fine. We'll take forward price to sales. Forward price to sales, the company is trading right now at a $93 billion market cap. And the forward price to sales for 2025 at this current market cap is 25. This is really high, guys. I mean, no matter which way you try to analyze this, this is extremely high. And you might be saying, well, they're growing revenue at a decent run rate. Yeah, but not enough to justify this. It's not Palantir growing these at 40%, right? So keep that in mind. You know what I mean? So price of sales is very high. You might say, well, what if you take 2027, 2028 sales like you just did on Meta? Okay, I'll do that as well. We'll take the 2028 sales of roughly $5 billion. We'll divide that. We'll divide the $94 billion market cap by 2028 price of sales. And you'll see right there, right? 93.63 divided by your 5.2. They're trading at 18 for price of sales for 2028. No matter how you run the numbers on this one, it is trading at very high multiples. But I know that valuation and technicals such as being overbought conditions. We've talked about the overbought conditions on the stock on the weekly. The monthly time frame is highly extended in terms of overbought conditions. The technicals are one thing, but Palantir's done this too. Some people could say, yeah, but Amazon did that for a long time. Tesla did that for a long time. Palantir did that for a long time. I agree, right? It's overbought conditions. Okay, so let's disregard the technicals. Let's also disregard the fundamentals because we know from Tesla, from Amazon, from other growth stories such as Palantir, sometimes they can stay, at high valuations for a long time as long as they have the sentiment. Well, now they have the sentiment right now. But essentially what you're doing, if you're buying this one, you're buying it on sentiment alone because you're not buying it for the technicals. It's definitely not cheap on the technicals, oversold or whatnot, right? It's definitely not cheap for the fundamentals. So essentially, the only thing that's left is sentiment. And you need to be the deciding factor whether or not you want to buy this for the sentiment alone and keep playing the game of musical chairs, right? And buying here and hope that you can potentially flip this to someone higher down the line. I have no doubt in my mind that Robinhood can grow its market cap to be a $200 billion company or possibly even more. But if the sales numbers and the earnings do not follow at that rapid pace, eventually when the growth metrics slow down, because right now they're okay, but if they slow down, the stock price is going to have a pretty deep correction. You know what I mean? So sadly for Robinhood right now, this one for me is not a buy. If you've got some shares from down here and you're up a lot of money, maybe you've taken some profits, okay, it's a hold for sentiment alone. It's not the cautious thing to do. It's not the logical thing to do, but I understand. Sometimes momentum and hype is or can be very profitable, especially in a bull market like this. But just be cautious. Just understand that if you're holding this one, you're not holding it because it's oversold. It's very overbought. You're not holding it because it's cheap. You're literally just holding it for sentiment and hype and momentum alone, which is fine. But just realize, guys, right? You don't want to be the last person left holding the bag. If this one does have one quarter in which they show a slowdown of growth, after which the stock embarks on a multi-week or multi-month period of consolidation, which happens to all companies. Matter of fact, it's happened to Robinhood a few times. Nice rallies, consolidation, nice rallies, consolidation. You just don't want to be the bag holder at that consolidation. So covered calls, taking some profits for short-term swing trades or on some long-term shares now that you've fully priced in revenues for 2028 and beyond. Not the worst thing in my opinion, and that's all I will say on Robinhood. But that being said, I would like to congratulate all Robinhood shareholders out there. You guys have done a great job holding on to those. Just don't round trip your gains is kind of what I'm saying here. When the market presents you a fantastic opportunity to take some profits. That's everything I had to say for Robinhood. Hopefully you guys enjoyed that. And now we're going to do company number 3, which is going to be ARM. So ARM coming out with their earnings after the bell today. And the company, we know that this one kind of suffered from the same thing as Robinhood. ARM has always been about the valuation. Now, right now, the company is down 8% in the after hours, and it's for a few key reasons. So a semiconductor player, a very strong company, guys, but my opinion on ARM has always been the same. It is one of my favorite companies in the entire market, but not to invest in. Just the overall company, I love what they do. I love their business model, but the stock price, I absolutely hate the stock price. And hopefully after this presentation, you'll understand why. Now take a look at their EPS. They beat on EPS by 0.25%. They missed on revenue by about 0.17. And the reason that I don't like the stock price, guys, is the valuation. It is very, very, very high. Actually, one of the highest in all of semiconductors. Yes, on a relative basis, the valuation here is higher than Broadcom, higher than NVIDIA, higher than any company you can think of in semiconductors. This is de facto the highest valuation in the entire market for the semiconductor landscape. Let's get into what exactly happened for earnings for them to come down 8%. So taking a look at the article real quick, ARM shares slip as smartphone royalties disappoint. So this is a company, guys, that essentially sells licenses and royalties for their designs. They are a chip designer. They do not produce them. However, that might be changing soon. Let's have a look real quick. The company said it expects second quarter revenue in the range between 1.01 and 1.11 billion, which was in line with the 1.05 billion expected. So this is for the upcoming quarter. Guidance was in line. So not raising the bar. That's not going to do it, guys. We've been talking about this all throughout the earnings season. If you come in line or miss on something and then come in line and guidance as well, the market's probably not going to respond too well to it. Moving forward, net income fell 42% to $130 million. Now, this is something that I've been talking about for ARM, for a while now at this point in time, guys. This is one of the companies in the market that has some of the best gross margins that you will ever see. Ever. Look at these gross margins, 95, 96% gross margins. Their cost of goods sold is tiny because all they do is they design stuff. They don't actually manufacture anything. However, they don't bring enough of that to the bottom line. Their net margins are just not high enough for a company that's making 95% on gross margins. They don't bring enough of it to the bottom line. Why, you might ask? Well, it has to do with this, guys. Stock-based compensation is absolutely ridiculous with this company. It's been a long-standing problem for the company, which is one of my problems with this stock overall. So that being said, their net income fell 42%, but that's not the only reason. Now they're actually investing in maybe becoming a chip manufacturer, not only design. So maybe that could erode margins even further. However, the CEO, so here we go. The CEO, Rene Haas, said in a Wednesday interview with Reuters that the company was consciously deciding to invest more heavily in technology beyond designs, confirming the company is considering designing its own processors. Executives told investors on an earnings call that the move could cause execution risk. ARM already sells technology to nearly every top chip designer, and ARM introducing its own completed chiplets or semiconductors could make its customers into competitors. Very interesting. Haas said that ARM might develop entire chiplets, which could be integrated into a custom chip, or it could develop the entire chip itself. We are now looking at the viability of moving beyond the current platform to additional subsystems, chiplets, or possibly full solutions. Once again, reiterating, its customers may become its competitors. I'm not too sure how I feel about that personally. Moving on further. But in the meantime, ARM's largest business, royalties for using its most basic technology in smartphone chips, has underwhelmed. The growth wasn't quite as strong in the smartphone sector as maybe we had expected, said the CFO. ARM said that because it is primarily a licensing company, it expects limited direct impact on our royalty and licensing revenues, but that the company has less visibility into the indirect impact on end demand, in the case that tariffs would slow sales of products with ARM technology in them. Basically saying, yeah, we sell designs and whatnot, but if the smartphone market continues to be a bit slow, well, then maybe people are not going to purchase our designs as much in terms of just talking about future refresh cycles for new designs. In licensing, customers have historically invested through near-term slowdowns given lengthy chip development timelines. So all of those things in the earnings release was enough to send the company down 8%. Number one, the fact that they actually missed on revenue here by a fraction. They came in line on EPS. And the fact that net income was choppy, to say the least, right? Coming in at 42%. Now, overall, ARM's business model has somewhat been, choppy in terms of margins and free cash flow. You can take a look here. Revenue has never been a problem, which are the blue bars right here. But look at free cash flow, right? Free cash flow is the orange bars right here. Very choppy, very, very, very choppy. You'd think that a company that's bringing in so much money, sure, they have to invest in research and development. They're a technology company that just designs. It's a chip designer, right? And then they license out, and then they have royalties on their products. Of course, they have to do a lot of R&D to stay ahead of the curve. That's normal, but the stock-based compensation is not, and that does eat into their net income. You can see net income is somewhat choppy here, especially over the last 2 years. Not very consistent, right? And neither is free cash flow, which is the orange bars. Net income is your dark blue. So the choppiness of that net income and free cash flow profile also does impact the company's consistency over time. Now, if you were to move into some of their earnings slides, we will see that the company highlights a few things that they're actually doing very well. So here's their investor presentation, guys. ARM is almost in everything now. They used to only be in phones, but now they're in everything: cloud compute, automotive, internet and things, and embedded. Here are just a few examples of the different designs that they outsource and license to these various companies, right? Total revenues, strong, 12% year over year. If you take a look down here, royalty revenue by architecture, you will clearly see that they make money on all their previous designs. The royalties continue forever. When they do new designs and basically sell those, they will continue generating money over time. Obviously, as companies move on, they use less and less of the old designs, but still they make revenue over time. You will see here that in 2016, they had a lot of market share. Well, actually, in terms of the revenue share, it was mostly only mobile. And now smartphones represent about 45%. They have a lot more now in various other end markets, which is good. So the diversification is there. Mobile applications, they still retain 99% of all designs in the entire market for smartphone designs, which is crazy, right? Other mobile, 70%. They've been making nice strides in consumer electronics from 2022 to 2025, 35% now. Cloud compute from 9 to 20, which is good. Networking equipment, 23 to 30. Other infrastructure, 12 to 15. Automotive, 36 to 44. Internet of Things, that is similar at 50%. And total opportunity, all those things combined, they're gaining market share, which is very good, of course. That is not the problem. The company executes very well. My problem with the stock is that a company is not always the same thing as a stock price. You can love a company and love its business model, but at the same time have problems with this stock price, right? Moving on in, annualized contract value, you'll see that that is always up and to the right, which is very strong. It's always been a very strong metric for ARM overall. And their RPOs, remaining performance obligations, still, the company usually puts aside, ARM on a regular year makes about $4 billion in annual revenue, let's call it, right? So if you take a look right here, they have roughly half a year in terms of remaining performance obligations, which is not too bad. That's been the norm for them as of recently, which is also pretty good. So you can see here a perfect example of a company that, yes, it executes well. They have very strong metrics and they have a wide moat. Their designs are second to none in the entire industry. However, because of their lackluster performance and their guidance that they might be competing with their customers, that leads people to take a little bit of a step back on the stock price. And another thing that might lead people to take a step back in the stock price is the valuation. So before we get into the metrics here, I just want to show you guys one more thing in terms of their EPS. EPS is growing nicely. That's not the problem. They have a very nice EPS growth rate here. And the revenue growth rate is also pretty good. We will see how much revenue they are able to generate from maybe them competing with some of their customers in terms of actually putting out the chips themselves. Now, that being said, the valuation, guys, is where I draw the line, right? Forward PE ratio at 150 is 84.26. Now, kind of like Robinhood, right? They're growing faster, though. 25% gain EPS in terms of an average per year for the next couple of years, which gives them a PEG ratio of 3.37. That is very high, guys, very high. And they have a lot of execution problems in front of them, right? Price to sales at 150, guys, you're talking about a 36 forward price to sales. Higher than Robinhood. This is high. It's higher than NVIDIA, guys, way higher. It's 2 times higher than NVIDIA. You are paying twice in terms of relative valuation what you would be paying for NVIDIA while NVIDIA is sitting at the all-time highs. That's nuts. And you may say, well, what if you take the price of sales by 2028? Okay, we can do that as well. Let's actually do that together, right? 2028 price of sales, let's say sales numbers right here, 9.44. If we do that, 172, let's do it right here. 172 divided by 9.44. That puts them at a price to sales of 18. Normally, tech companies and even semiconductor companies trade at about a 10 to 12. So even if I project all the way out there, guys, it's still too expensive, right? It's just still too expensive. So ARM is not my first pick. And I will reiterate, I love this company. They have a tremendous competitive advantage. They have a tremendous moat, but may face some execution problems in the future. And as a result of those risks and their valuation, I am just not going to bid for this stock. If the stock price was better for me, like under $100, I would be all over this company. As a matter of fact, during tariffs, I said that it was indeed a buy. But up here is now where I kind of draw the line. I think there are many other great opportunities in semiconductors right now that don't have the execution risks of a business model pivot, but also don't have this high of a valuation of a premium that you're paying for the stock. Those are my humble opinions on ARM. So that wraps up all our earnings, all of our earnings recaps for today. And now let's jump into some of the indexes, shall we? So in terms of the SPY, you just need to understand that the bulls currently retain absolute full control. Actually, as a matter of fact, we backtested the 12 EMA. So tomorrow, if we do open higher and get a little push, your higher low is right here now, 632.11. The bulls still in full control of this chart. Higher low is set, and we might just be looking for an end of the month expansion to wrap up the month of July. And a matter of fact, guys, just pay attention to this 12 EMA. It should be your short-term guide. In the event that you lose this and set a, let's say we set a daily downtrend as a result of this and lose the 12, then and only then will you be embarking into weekly consolidation. But until that time, as I always say, the bulls are in full control. The backtest area down here, 611 down to 600, which would be support, and the 12 EMA into that range as well. Into the QQQs right now, QQQs up 1.08 in the after hours. The Qs looking very strong. Once again, grinding this 12 EMA. This should be your short-term momentum guide. When the bulls lose this and lose the uptrend, that is when you know you're in for a bit of weekly consolidation. Whether that comes tomorrow, whether that comes next week, whether it comes sometime in the fall, that is what we will obviously see together on the channel. But as of right now, the bulls are looking very strong. Any extended pullbacks would probably pull you back into a weekly higher low. And at that point, you have nice support down below here, 538 down to 520, and the 12 EMA is right there too. So as of right now, guys, the markets are still looking very strong. I know. It is the most hated rally for a reason. You might think it's overbought. You might think this can't possibly keep going higher. Let them show you when the consolidation happens, and your clear indication will be the loss of the trend and the loss of the 12 EMA, something that has not happened in the last 3 months. So rather than trying to speculate and predict, just react to the price action. On to financials right now. Financials daily downtrend into a nice leg of expansion here. The bulls are trying to engulf, set a new higher low, and maybe go for a little bit more. We get to hear from MasterCard earnings tomorrow, which could lift the index a little bit. That being said, higher low is set 51.32, looking for a new higher low for possible expansion. We got some very nice support below 52.12, down to about $50 right down there. Not too bad on the indexes, guys. The bulls retain full control of financials as well. And we're just maybe looking for a bit of a consolidation range here above the highs. Unless you truly lose this guy right here, 51.30, and dive deeper into this support range, I wouldn't be too nervous, guys. The bulls are right now in good shape in terms of this weekly time frame. Onto healthcare right now. Healthcare sadly down 0.18, another 0.6% in the after hours. The clearest time frame, in my opinion, guys, is not the weekly anymore. The weekly is just cloudy, right? Just somewhat of a tightening range here at the bottom. We're reacting nicely from the 200 weekly EMA, which is something we have not really tested much. We tested it once during COVID, once in 2015, and then the last time in 2011. It is a buy zone, but healthcare is going to be very, very, very slow in my humble opinion, guys. It's been lagging behind the SPY. The clearest time frame is the monthly, right? It's a monthly downtrend. We're looking for the smaller time frames to eventually reverse into a bit of expansion. Take a look at 137. If you break 137 and give a nice weekly candle close, then it started, and then you could talk about a monthly leg higher back into maybe 147, but then they'll have to reverse the monthly, right? Changing around a monthly time frame takes a very long time, but as of right now, it's a nice accumulation zone into our support area, which is 136 on a 121. So you got to be patient. You guys know me. I'm not playing individual companies. I am playing the ETF as a whole. Onto semiconductors, up about 1.15%, possibly with the renewed capex from big tech. You might see some good gains tomorrow. NVIDIA right now up 2% in the after hours, which is very, very, very good. Even though some players which had earnings such as Qualcomm, sadly we didn't cover it, they're down 5. ARM also is down 8. And then we had another one, LRCX. LRCX is also down about 5% right now. NVIDIA, though, benefiting, and even AMD benefiting in the after hours. So it's going to be push and pull on semiconductors tomorrow. Should be another strong day for your data center names tomorrow. TSMC also, if we move down here, they're also up roughly 1% in the after hours. So semiconductors, guys, still looking very strong right here. Daily uptrend is, very clear right now. Clear as day, I would add. And any move lower looking for a higher low, anything above 283 looking for a new higher low for possible further trend continuation. It's literally just that simple. Pay attention to the 12 EMA. If you lose the 12 and you lose the trend, then you will know that weekly consolidation is underway. Until the time that happens, the bulls are in full control of this chart. Beautiful weekly uptrend right now. I know it's getting a little bit overbought on the weekly. I know it's been oscillating overbought on the RSI for the daily, but until the time that you see the bulls lose this trend, they will continue pushing the levels until enough is enough. Wait for them to show you rather than saying, oh, it's too overbought, I'm shorting. It's too overbought, I'm shorting, right? Don't think like that. Don't predict, just react to the price action onto IWM right now. IWM not performing too well, and of course that's because of the yields coming up. As of what we saw, right, in terms of the September rate cut probabilities, that kind of shot yields a little bit higher. So today, the Russell not performing too well, still struggling with resistance, 232, down about 225. Below remains support, 217, down to 207. The weekly time frame is a little bit choppy right now. Although the bulls retain control, you'd just be looking for a higher low in the event that you do break down. I might be looking to shop for the Russell down here into support, but until the time that that happens, guys, we're kind of at the midpoint right now between resistance and support. So I know that growth has been left behind, but this one really moves with yields more so than anything else. Moving on to the VIX. The VIX actually, during the Jerome Powell conference, spiked up. The VIX was up like 6-7%. And at the end of the day, as a matter of fact, ended down. And probably tomorrow after these earnings, the VIX will end up down again. So you guys that were trying to predict the rally in the VIX, a lot of people asking me, I have VIX calls. What should I do? It's just been bleeding. Well, you got to kind of benefit from these rallies to maybe just offload the position and reset for more time. But you're still just waiting for the next volatility catalyst. It's a low volatility environment until the macro breaks or until earnings actually break. And I'm not talking about price action. All the companies so far, most of the companies have reported very good numbers. It's just the price action has been trash on some companies, but they have not really reported bad numbers. Nobody's saying that the consumer is weak. They're saying that there might be a few tariff concerns down the line, but nothing is breaking as of right now. So you do not have a volatility expansion catalyst, so keep that in mind. Volatility still remains a little bit low. Yields obviously to the upside, but that's a byproduct of what the Fed said. They'll stay planted here at 4.5, and the 20-year will stay planted in around 5%. You know, you might see some slight action on the bonds, but for the most part, bonds have been very weak, guys. Once again, it's an accumulation phase for the bonds. They will not rally until we get confirmed rate cuts. As long as the Fed keeps pausing, essentially, keeps just pushing back the timeline, yields are just going to stay exactly where they are. So keep that in mind. If you are trying to invest in bonds right now, trying to go for the rally in TLT, it's just not ready yet. Moving on to gold. Gold actually was down all throughout the day, getting dangerously close, guys, to 3250. Pay special attention to this. Daily uptrend, this has now been unwound. If you get a move higher, maybe just looking for a lower high, possibly for the lower low. This is the first time that they've closed in a significant fashion below the 50-day EMA. That is notable to me. It might be in the weekly time frame the only time that we've closed below the 12 EMA, which is the momentum guide, right? We saw it on the daily for other things. This time it's the weekly. It has to be notable to you. When there's a shift like this, after several months, something is different right now, and maybe that's the fact that, well, inflation is not rearing its ugly head anymore, and maybe the macro is just too good for people to pivot into gold as a fear trade or an inflation trade or the combination of both. So if you lose 3250 right now, that is a weekly downtrend. And what do we know about losing the 12 on any time frame and setting the opposite trend? Well, you know to look one time frame higher because it might be the start of that time frame's consolidation. In this case, monthly consolidation. Pay attention to that. Look at this, guys. A monthly RSI has been overbought. That might just be the catalyst. If you do break down there, I would not be surprised if you get continuation down here. 3,000 is possibly going to be the consolidation target for gold. Not immediately, but maybe just slowing down until, as I said, something breaks to pivot people back to gold, which is sometimes a fear trade, sometimes an inflation trade, sometimes a combination of both. On a Bitcoin right now, Bitcoin down on the day about 0.32%, but still not flushing, not closing below this guy right here. 116,200. You can call it 116 flat if you really want to. Let's call it 116 flat, yeah? Very nice bull flag right now. And I call it a bull flag because on the weekly time frame, you're just holding the top end right there. It's a very nice weekly upswing right now by the bulls. They're holding these lows. The bias still does remain for long side continuation up to 125. However, if you break the floor and head lower, very simple, guys. You're just looking for weekly consolidation in a very healthy uptrend right now. Anything above 98,000, looking for a weekly higher low. If we do come down, you're coming down there 110, 109 into the weekly 12 EMA. The bulls are still looking fine on Bitcoin, in my humble opinion. That is everything for your overall market rundown. Hopefully you guys enjoyed. Now let's dive into some big tech names. So taking a look at Apple first, Apple down 1% on the day just because there was some news about tariffs towards India, 25%. However, Trump did say today that this was an ongoing negotiation. So obviously Apple has shifted some of its production to India. So that tariff news that was not advantageous to them today overall. However, maybe none of this matters because Apple has earnings tomorrow. And I'll remind you of the expected move for Apple, expected move for Apple tomorrow is probably going to be somewhere around 3.5%. So 3.5% higher from here. If they have good earnings, we'll put you right into the resistance range again, 213 up to about 221. And if we get a 3-4% move to the downside, it's going to be heading into support. So rather than me trying to predict the direction of earnings, I'd rather just tell you what I'm going to do for some trades. If we come down lower, I will be gladly selling some short puts on Apple and maybe even accumulating some swing trade longs into these tariff fear lows for possible reversal and catching up to its sector peers, because we know that Apple has notoriously been lagging behind its sector peers, still down year to date, 16.52%. In my opinion, that will not last forever. Whether it still lasts for another couple weeks or something like that, my duration for any swing trades on Apple taken down here is probably going to be the next like 3, 4, 5 months, right? Which is why I'm positioning for some leap calls with a very long time horizon on those contracts to kind of let them iron out all the price action that they can. All I know that is I do want to be a buyer down here into support. And if we rally, well, I do already have the contracts in motion to actually ride those gains. So we'll have a look at Apple earnings tomorrow. Front and center will be the focus on AI, the rollout of the new iPhone 17 in September, and some guidance maybe associated with that. And we're going to also have to see their commentary on the tariffs. Is it meaningfully impacting their business right now? All things to take a look at tomorrow in their earnings. AMD up 1.17% today and a little bit more in the after hours. 2.44 overbought conditions is very clear right now, and maybe breaching above the top end of resistance on AMD. This was a very, very pivotal moment for AMD. We'll see if they can actually smash this and close the weekly above it. However, we are extended on most timeframes right now. It's been a crazy rally on AMD so far. Congratulations to all the shareholders who were listening to me down here when everybody was clowning us, calling it advanced money destroyer and things of that nature. People were leaving comments. Why are you buying AMD? I would never buy AMD. All it does is go down every single day. Well, nothing lasts forever, guys. The thesis was very clear. I've had this thesis now for the last 6 months publicly on the channel, right? It was always a question of time, scaling into their EPS, scaling into their revenue with the release of their data center chips. And the CEO was very clear on that, right? The rollout took a little bit more time than expected, but now the rollout is very clear and it's working wonders for them. As of right now, the short-term timeframes remain a bit overbought. And if we get any pullbacks on AMD, guys, you're possibly just looking for a higher low, anything above 148 looking for a higher low for possible further trend continuation. Look at this chart. They control the 12. Clear daily uptrend. Yes, we're overbought, but let the bulls tell you when they're done, essentially. If we just break through this area as if it's not even here, you know where we're going. We're going straight to 200 psychological for AMD. And I've been saying this, even at 175, 180, the valuation in terms of a forward PEG ratio is not that bad at all. And even in terms of price to sales, we just looked at ARM, right? We also just looked at Robinhood. Those had crazy rallies. This also has a crazy rally. But if I compare AMD, just in terms of relative valuation, the PEG ratio is not that bad, and the price to sales ratio definitely is not that bad, especially for all the growth that they have in the future. So keep that in mind. Moving on to Amazon. Amazon has earnings tomorrow. They're up 3% right now in the after hours. Very strong move, possibly because of Microsoft's cloud revenue. So we'll keep that in mind for AWS. Google said that last week, that they had very good cloud numbers. Microsoft said that again. AWS is the largest cloud provider on the planet, so we would assume that their numbers should be pretty strong. That being said, the expected move for Amazon tomorrow is roughly around 4%. It should still be 4%. Yeah, 4.66%. So 4.66%, if they have this gain into tomorrow, 4.6 on top of this, you're looking for brand new all-time highs on Amazon, guys. If they smash it like Meta and Microsoft did, you might be pushing 250. So I'm very happy that I'm in this, my largest position in my portfolio. I was very vocal in building leap call contracts back here when Amazon was down because their business model is just so strong. They're an octopus. They have arms everywhere. Amazon Prime Video, their pharmaceutical business, their robotics business, Project Kuiper, let alone their advertising business, which is burgeoning right now. And of course, we talk about AWS and their e-commerce business as well, which is their massive line of business that everybody knows them for, right? It's an octopus. It's one of my favorite companies on the planet. If you get that 4 or 5% rally, you're into new all-time highs, possibly 245, 250 will be looking very strong. But if they miss the bar and come down, what are we looking for here? Well, tomorrow we're going to open here. If they miss the bar, you're just looking maybe for a back test of support, 228 down to 217. I'll be looking to buy some more Amazon if they actually give me such a fantastic buying opportunity, because at the end of the day, all you'd be looking for is a weekly higher low off of that sell-off. down into maybe 220, and I would be a buyer into that 12 EMA, selling some put contracts down there, but maybe adding to my share position as well. Fantastic company, well-rounded company. I think AWS is going to do good, but no need to predict. We'll cover it on the channel tomorrow together. Moving on to Google right now. Google up 0.51%. I mean, Google not doing too bad since their earnings, right? They gave back a little bit after earnings and then just kind of kept moving higher. So overall, not too bad on Google. Still a very nice daily uptrend in motion right now. So any move lower looking for a higher low, anything above 181 looking for a new daily higher low in this gorgeous uptrend for possible further trend continuation. And where we might come back into 190 down to about 183 is going to be that target range for us to kind of fall back and find some support for the bulls. The weekly uptrend is gorgeous right now, and we have a lot of space, anything above 165. So even if you lose this, right, you're just looking for a bit of a weekly downswing, and I would gladly sell some puts and gladly buy some Google shares. I would not even mind buying more Google shares up here. Matter of fact, I did buy some just last week, even at 190, even though I was buying all in this area and obviously down below there. I've been in Google for years, guys, since like 2018, 2019, right? So even at 190, Google is presenting a very decent risk reward trade-off. Sure, there's the Department of Justice overhang. Sure, there's the whole ChatGPT is destroying their search business, but is it really? We did their earnings last week, guys, and clearly not. They're still very, very dominant in the search landscape right now. Moving on to Meta. Well, I mean, we just covered their earnings, right? So Meta, just in terms of the price action, we'll keep this short and sweet. Weekly uptrend was very strong, right? Very strong. The higher lows were here, 678. Now your new higher lows are going to be 691, and you're going to have a candle up here. So in the event we give some back, you got a lot of fallback area, possibly coming back and touching the 730 prior all-time highs for a bit of a breakout, maybe retest and run. That's the downside. If they keep running up, well, then you should keep psychological targets in mind, such as 800. It's going to be the next target for Meta. Very nice expansion. I'm not buying it tomorrow at the open, nor putting on any swing trades. But if they dip throughout the fall or something like that, I'll definitely be looking for some swing trades for a gorgeous breakout of an all-time high range and maybe backtest into it, usually a high probability setup. On to Microsoft right now. Well, we just covered Microsoft as well. Microsoft pushing 550 right now. No trades for me. The stock is trading all the way up there. You guys know who's in control of this one. Tomorrow, the daily time frame will be massively overbought, and the weekly time frame as well will probably be massively overbought. It is a gorgeous weekly uptrend, but just not for me to participate in right now. I would rather wait for some consolidation, establish some support levels, establish some stop loss areas to be building some trades off of, and we'll kind of take it from there, right? Moving on to Netflix. Netflix up about 1.32%, but coming into resistance right now. I'll just kind of change this box into red just so you guys are not confused, but it should be fairly obvious, right? Netflix right now, daily downtrend. They had very good earnings, but still, the market's selling them down a little bit. If we reject and move a bit lower, we are probably heading to this guy, 1107 and then 1100 psychological. It's just been weekly consolidation for Netflix after a beautiful quarter. Just a bit of a consolidation period for Netflix. They lost the higher low consolidation, which means that your monthly time frame is also in a consolidation phase. That being said, next stop $1,100 and maybe all the way down to about 1,000. If we do come into there, that's the next area that I'll be adding. I've been very vocal in saying that, you know, this is kind of like Microsoft, right? There's times to be buying these fantastic companies. I was not a buyer up here, but I'm starting to get a little bit more interested as we kind of come down into the $1,100 range. If we never get there, I'm fine. I already have all the Netflix shares that I could possibly want. The future long-term prospects of the company are looking quite bright. Moving on to NVIDIA right now. NVIDIA up 2.14 during regular trading hours and another 2% in the after hours. So looking very strong here. The trend is clearly to the bulls right now. Beautiful leg of expansion. Any move lower, looking for a higher low, anything above 164. New higher low for possible further trend continuation. Next psychological target, you guys know, it's the big $200 psychological. I know it's crazy. I know NVIDIA is overbought, but you guys know how this goes, right? When this whole sector runs hot, it runs hot. What do you expect? It was consolidating for a year, for a whole year. Now that's the accumulation phase. Now you get the distribution phase, right? So that being said, the weekly bulls are in full control of this chart. Any pullback looking for a higher low, maybe back to the 12 EMA, which is at 156. But in my opinion, that's not going to come unless you get S&P and QQQ consolidation, maybe from some macro, maybe from some seasonality. We will see, but the consolidation factor for NVIDIA is not here just yet. Let the bulls show you. They'll show you, right? Let them lose the daily uptrend, which they haven't done in 3 months, and let them lose the 12 EMA, which they also haven't done in 3 months. As a result, right now, the bulls are in control. Moving on to Tesla right now, still a consolidation range. cleanest time frame for me remains the weekly time frame, just accumulation between two zones, 360 down to 340 and 300 down to 260. I know I don't spend much time on Tesla, but that's because there's no trades, in my opinion. A trade would have to be placed down here in the lower 300s with the stop loss maybe below these guys. What you're essentially going for here is a back test and then expansion into the resistance highs. When it's in the middle right here, what do you want me to do? The stop is down there and the take profit is there. It's equidistant risk to reward. So there's no swing trade for me on Tesla right now. But that being said, they've been holding up price action pretty good after the earnings that we had. And for a long-term investment, because we always talk about long-term investments on all these companies, is it worth it? Well, I'll let you guys be the judge of that, right? If you think Tesla is only a car business, well, obviously the numbers would point to the fact that they're very overvalued. If you think that it's more than a car business and believe in the long-term vision, especially robotics, FSD, robotaxis, energy business, and all that good stuff, well, then you might think the company is undervalued. So the choice is always up to the investor at the end of the day, which company they think Tesla is. Moving on to Palantir right now. Palantir up about 1.52%. They have earnings on Monday. Not that many days of price action remaining for Palantir, so I would not be surprised if they don't have a crazy push into earnings, but also they don't have a massive, slide into earnings as well. They might just maintain price around the $160 mark. Daily bulls are in full control right now, but not that many days. Earnings is going to move this company probably like 5, 6, 7+%. So that being said, if that happens after earnings, you're going all the way up there to about 170. If it comes down, you're probably coming all the way down here into the 140s. We will reanalyze the price at that point in time. Can't talk about it too much because I'm not positioning into earnings overall. If anything, I've been selling covered calls on my position, my remaining position on Palantir, into earnings because the valuation is pretty rich right now. But I love this company. I love their business model. I love what they're doing. But once again, the stock price, I don't love so much right now. And I love it because I'm up a lot of money, but let's be honest, right? It's pretty expensive right now. Moving on to SOFI. SOFI was actually down 2%, but at one point today was down 7%. We covered their earnings after the close yesterday. So SOFI was able to recover a lot of those losses today and holding up pretty well. You know, we didn't cut this low right there, which was about 19.72. So the bulls just consolidating, trying to set a new higher low right now. We'll see if they can keep it in check, but we know there's a big resistance range here, which sadly we were not able to push through with earnings. It's a big one, guys. You know, you got all these guys back here from 2021. They might have been bag holding for years. Maybe they just offloaded some shares for break even. I don't know. Maybe 24 down to 22.5 is that resistance range. We will see how the weekly candle closes. But in the event that you move lower, right? I would be a buyer of SOFI down here around $18 to $17. Even 19 is not that bad. I just want to pull back into the 12 EMA. If it happens, perfect. If it doesn't happen, no problem at all. I have a ton of SOFI shares that I bought all the way down here and prior as well. But the last batch I was able to buy down here in roughly the $10, $11, $12 range. So I'm happy with what I have. We covered their earnings yesterday at $21. It's not a bad buy if you have a 3 to 5 year time horizon for the expansion, long-term expansion of the company. They're growing very well. On to Uber right now. Uber up 0.61%, but we know the bears are in full control of this time frame right now. Any move up might just be looking for a lower high into resistance, 92 to 90. And then, well, I mean, if you want to see a reversal here, you need to get the bulls to reverse the time frame, right? As long as we don't see that, the expectation is for future consolidation until we find our weekly higher low. We start working with a bit of space here, anything above 83, looking for a weekly higher low for possible further trend continuation. The entire time that we slide, maybe I can find some short put opportunities down here in an 83, lower 80 range. I would be a big fan of playing Uber down there, but we don't have that much time. This company reports earnings next Wednesday. So maybe we don't move too much before Wednesday. Probably not going to do this. And maybe we also don't do this much before their earnings. Maybe we just stay right around here, high 80s. I'll be looking forward to their earnings come next Tuesday. And last but not least, we have TSM here. TSM up 0.65% and another 1% in the after hours because of the CapEx spend by Meta and Microsoft. This chart is as clear as NVIDIA and as clear as many other charts, grinding the 12 EMA for the past 3 months, essentially, and a beautiful daily uptrend. If you flush these lows, okay, without new highs, and you lose the 12, then that is daily downtrend, the first one in 3 months, and you're just looking for healthy weekly consolidation. Until that happens, the bias is still for long side continuation. I know it's hard to say, but it is what it is, guys. I don't make the price action rules, right? It's just the trend is your friend at the end of the day. You know what I mean? So that being said, guys, if we do pull back, maybe some likely areas of pullback might just be 220 prior all-time highs and the 12 EMA on the weekly time frame. That'll be a healthy pullback. The bulls have a lot of space here for that pullback that they're working with. Anything above 206. The valuation of TSM here at 245 is actually not all that bad. So referencing ARM, right? for two companies that are growing revenue and EPS very, very well. Look at ARM's numbers, yeah? ARM is growing revenue and EPS double digits, very good double-digit numbers. TSM's growing EPS a little bit less, but look at the valuation that you're paying here. For ARM, look at TSM. TSM's at the all-time highs. So if you only look at the chart and you don't know the fundamentals, you might think, well, ARM hasn't reached all-time highs, so it must be a buy. TSM's reached all-time highs, so it must not be a buy. Don't think like that. Just look at the numbers objectively. Sometimes forget about the chart. Would I continue to add shares if I had a long-term vision of TSM for the next 3 to 5 years? The answer would be yes. Maybe not a full-size position to the tune of what you could have started back there, but still not a bad time to be adding some long-term shares to the portfolio. And with that, that wraps up everything that I had for you guys today. Apologies, guys. I won't do it. The video is just too long for me to cover the top gainers and losers of the day, many of which we've already covered. Today, there were some nice ones, of course, but we're going to have to kind of do that, guys, on the Friday session. We'll spend a bit more time on it, but when I do 4 earnings per day, I'd rather spend some time on these earnings. Because when I just go through the top gainers and losers, I spend 30 seconds on the price action. Maybe it helps you, maybe it doesn't, but maybe understanding the fundamentals behind a lot of these companies that have earnings this season will help you better understand how to position trades or long-term portfolios. I know you guys are all about the trading and stuff like that, but when we're not in earnings season, I do the top gainers and losers every day, and I spend like 10-15 minutes on them. So forgive me if now we're kind of going to skip over them on some days when the video is a bit long. That being said, that's everything I had for you guys today. If you enjoyed this content, it takes me a long time to put these videos together and do the earnings recaps and all of those things. Please drop a like on the video, would really appreciate it. And also, if you would consider subscribing, I would really enjoy that too. We do these videos every Monday to Friday after close. Hopefully, I see you back in the near-term future. Last but not least, if you have any questions on the video, please leave them down below in the comments section. I always love to read your guys' comments. And as per usual, if you guys are interested in joining our trading and investing community, the details of that community are down below in the video description. You get access to all my trades in real time, our private morning live streams Monday to Friday for about 2-3 hours. You can ask me all your questions in our live streams or our chat rooms, all your questions on your stocks, your options, your long-term portfolios, and I will give you just an as detailed answer as I do give on these videos, right? So I give very, very well-rounded answers in the Discord to any of your questions on stocks, options, and things of that nature, and tons of other things that are included in the service. So if that's interesting you, please click the link down below, and hopefully I see you in the community soon. If not, I'll see you back on the channel, guys. That's it for me. Have a good evening. See you tomorrow for more earnings. Take care and peace.